Have you ever wondered how an audit knows exactly what to look at, or where its boundaries lie? A business audit scope is primarily determined by its specific objectives, which are established through discussions between the auditor and the client, often influenced by regulatory requirements, industry standards, and the type of audit being conducted. The core mechanism behind this determination involves a careful assessment of the audit's purpose. For example, a financial statement audit aims to verify the accuracy and fairness of a company's financial reports. This means its scope will focus heavily on transactions, accounts, and internal controls directly impacting those statements. In contrast, a compliance audit might specifically target adherence to certain legal frameworks or industry regulations, narrowing its focus to activities related to those rules. The auditor and the auditee, or the business being audited, collaborate to define these objectives, ensuring all relevant areas are covered without unnecessary intrusion into unrelated operations. For you, as a business owner, this means proactive engagement is key. When preparing for an audit, clearly communicate your primary concerns or the specific areas you wish the audit to address. For instance, if you are seeking a loan, the lender might requiring an audit focused on specific asset valuations or revenue recognition practices. You should also be prepared to discuss your business operations, internal control systems, and any recent significant changes, as these details help the auditor tailor their approach. This collaborative process ensures the audit delivers the most relevant and valuable insights for your specific needs. A crucial document in this process is the engagement letter, which formally outlines the audit's objectives, responsibilities of both parties, the period covered, and importantly, the agreed-upon scope. This letter serves as a contract and helps prevent misunderstandings later. Different types of audits, such as an internal audit versus an external audit, will naturally have different starting points for their scope discussions, reflecting their distinct reporting lines and purposes. For instance, an internal audit might have a much broader operational scope, defined by management's needs, while an external audit will often be bound by generally accepted accounting principles or governmental audit standards. By understanding the drivers behind audit scope determination, you can better prepare your records, allocate resources, and communicate effectively with your auditors. This thoughtful approach ensures the audit is not just a regulatory hurdle, but a strategic tool that provides clear, relevant insights, helping you to protect your business, enhance its operations, and build stakeholder confidence.